Hi, my name is David. Most people think investing is about being smart. It's not. It's about having a system that protects you from, well, from you. Today, I'll show you the system that saved me. After my financial setback, I realized something painful. I didn't have a plan. I had reactions. Fear made me sell. FOMO made me buy. And emotions, they cost me thousands. So I built a rules-based system, one designed to strip emotion out of the process. It protected me from impulsive decisions and kept me grounded when the market got noisy. This wasn't guesswork. It was built on historical market performance and shaped by the current macro environment, using insights from firms like Vanguard and BlackRock. It gave me structure. It gave me clarity. And most importantly, it gave me the confidence to stay consistent, even when everything else felt uncertain. Here are the rules I follow today. Simple, consistent, and surprisingly powerful. Rule 1. I invest on a schedule. No market timing, no guessing, just automatic contributions that keep me moving forward. Rule 2. Every dollar has a job. Growth sleeve, income drip sleeve, international sleeve, dividend sleeve, core foundational sleeve, stability sleeve, commodity sleeve. Each one has a purpose, no overlap, no confusion. Rule 3. I don't rebalance by selling, ever. I shift allocations using new contributions only. But if you're nearing retirement and your portfolio is too aggressive, or the macro environment has changed, rebalancing may be worth considering. I'll show you how I use AI to evaluate my allocation in an upcoming video. Rule 4. I stay inside my guardrails, even when the market tries to scare me out of them. The second act investor system uses dedicated accounts, employer 401k, Roth IRA, retail brokerage, a high-yield savings account, and a health savings account. Each account has its own sleeve structure, allocation percentage, and drip strategy. If you're ready to rebuild, learn the rules so you can stay engaged. Use AI prompts to evaluate your portfolio and benchmark your allocations against guidance from top U.S. investment institutions. And yes, there's a free online university course that teaches you how to use AI prompts effectively. I dropped the link in the description. Stay encouraged, learn, grow, rebuild. As a second act investor.
So, how did I set up my portfolio? Let's break it down. First, let's talk about the types of accounts I use, because in my system, every account has a specific job. The second act investor portfolio is coherent, risk-aware, tax-efficient, and built for long-term compounding. The first account I set up was my employer 401k. If you're self-employed, that's your solo 401k, sometimes called a business 401k. Now hear this. My employer 401k has a very specific, non-negotiable role inside the second act investor system. It's not a general-purpose account. It's a sleeve-defined engine with two core jobs. Job 1, stability engine, the anchor of your portfolio. This account provides sequence of returns protection, a hedge against volatility during downturns, a safe base that lets your Roth and retail accounts take more growth risk, a home for broad market and fixed income exposure without tax drag. Job 2, international and U.S. broad market core exposure. Your employer 401k is the home for broad U.S. market exposure, international developed market exposure, excluding U.S. equities, fixed income and money market funds, sized based on age and risk profile. This structure frees your Roth IRA to focus on pure growth and your retail account to focus on tax-efficient growth and income-producing assets. My Fidelity Employer 401k allocation at age 61. 30% FXAIX, S&P 500 Index Fund. 40% VTMGX, Vanguard Developed Markets Fund. Why so high? In today's weak dollar, high debt environment, international equities have outperformed U.S. broad market returns since 2025. 30% FNBXX, Fidelity Money Market Fund. I use this for quarterly in-service rollovers into my self-employed 401k. More on that in a moment. Additional functional rules. These rules are secondary, but still powerful. Rule 1. Automatic contributions plus employer match. Always contribute enough to capture the full employer match. If you're self-employed, you can unlock mega backdoor 401k contributions. We'll cover that in a future video. Rule 2. Optional quarterly in-service rollovers. If you're 59 and a half or older, you can use in-service rollovers to move funds into your employer or business 401k, traditional IRA, Roth IRA. This gives you access to broader investment options and lets you build your fixed income sleeve before contributing to your growth sleeves. Here's how I built my fixed income, high liquidity stability sleeve using quarterly in-service rollovers from FNBXX. My stability sleeve allocation: Ultra Short Treasury Core, 0 volatility, 40%, SGOV, 25%, BILS, 15%, Ultra Short Active Credit, Cash Plus Yield, 30%, PULS, 20%, JAAA, 10%, Short-Term Bond Stability, 30%, VGSH, 15%, VCSH, 15%. Rule 3. The no-sell rule. Because I rebalance using new contributions, not by selling, this account is perfect for holding long-term core positions, adjusting allocation only through new contributions, maintaining clean sleeve boundaries. In short, your employer 401k is the stability, international, and U.S. core engine of your portfolio, the ballast that allows every other account to specialize and compound efficiently. Disclaimer: I'm not a financial advisor and nothing here is financial advice. This channel exists to share my personal journey, the mistakes, the lessons, the systems, in hopes that you'll build your own plan to rebuild. Investing always involves risk, and past performance never guarantees future results. Consider speaking with a certified financial advisor to create a plan tailored to your needs. Let's get back to learning. The second account you set up is your Roth IRA. The goal is to contribute the annual maximum amount. In 2026, if you're under 50, the max contribution amount is $7,500. Over 50, the amount is $8,600. Your Roth IRA is your pure growth engine, the highest octane, longest horizon, tax-free compounding account in your entire portfolio system. Everything else you own bends around this purpose. Your Roth primary purpose is to 1. Maximize long-term, tax-free growth. Your Roth account is where you place the assets with the highest expected long-term return, the highest upside asymmetry, the longest compounding runway, the lowest dividend drag, the most innovation, momentum, and secular growth exposure. Because Roth withdrawals are tax-free, every extra bit of growth is amplified. 2. Accept moderate volatility for higher return. To be clear, your Roth IRA is allowed to be spicier than your other accounts. Why? Because your employer 401k and/or self-employed 401k carry the stability sleeve, which absorbs the shocks. That frees the Roth to chase growth, not comfort. 3. Zero income, zero value tilt, zero drag. Your Roth IRA intentionally avoids high-yield ETFs, value-tilted funds, covered call products, dividend-heavy ETFs, anything that slows compounding. During your rebuild, your Roth is not your income sleeve. It's your high-octane growth sleeve. 4. House the sleeves that benefit most from tax-free compounding. Your Roth IRA is the home for growth ETFs. Examples include SCHG, QQQM, VUG, MGK. Momentum ETFs. Examples include SPMO, XMMO, MTUM. Innovation sleeve. Examples include SMH, XLK, FTEC, VGT. Secular trend exposure. Examples include SHLD, PPA, EUAD. Alternative investments and commodities. Examples include GLDM, GLD, IAU, SGOL, URA. These are examples of assets that explode over 10 to 20 years, and you want that explosion to be tax-free. 5. Support your desired retirement year. Your Roth IRA is the account most aligned with your long-term retirement target. The Roth is the engine that pushes the curve upward. It exists to be your highest growth, highest upside, tax-free compounding engine, built for long-term wealth acceleration with moderate volatility and zero income drag.
The third account you should open is a retail brokerage account. Your retail brokerage account is your tax-efficient dividend and growth overflow engine, the place where long-term wealth compounds after you've maxed your employer 401k, at a minimum up until the employer match. Roth IRA up until the annual max. Optional but recommended, your health savings account. It's designed to grow quietly, flexibly, and efficiently, without triggering unnecessary taxes or volatility. Your retail account has 3 core jobs. 1. Tax-efficient dividend growth engine. This sleeve is built to hold. Low turnover dividend ETFs, qualified dividend-heavy funds. Broad market growth ETFs with tax efficiency. Top examples: DGRO, dividend growth, low turnover. VIG, high-quality dividend payers. DGRW, rules-based dividend strength. Why this matters: qualified dividends equals lower tax rate, low turnover equals fewer capital gains, ETFS equals built-in tax efficiency. This keeps your retail sleeve clean, predictable, and low drag, perfect for long-term dividend compounding. 2. Long-term growth overflow engine. Once your Roth IRA is maxed, your retail account becomes your secondary growth engine. This sleeve holds growth ETFs like SCHG, VUG, or QQQM, momentum ETFs like SPMO, equal weight ETFs like RSPG, value, ETFs like VTV, VONV, or VOOV, core broad market ETFs like SPYM, VOO, or FXAI, alternative assets like FBTC, Bitcoin, and GLDM, gold, optional fixed income sleeve. For stability and cash parking after your emergency fund is full. Ultra short treasuries, SGOV and BILS, active credit, PULS and JAAA, short-term bonds, VGSH and VCSH. These are tax efficient enough for taxable accounts and complement your Roth's pure growth focus. 3. Flexible liquid planning engine. Because it's taxable, your retail account is also a strategic planning tool. Liquidity buffer for household needs, flexible funding source for future goals, non-retirement compounding engine you can tap without penalties. Use it for credit card payoff planning, cash flow flexibility, post-mortgage compounding, and escrow funding. It's not your emergency fund, but it is your long-term liquid wealth bucket. Why this account complements your system. Your retail brokerage is tax-efficient, dividend-friendly growth, capable, flexible, and liquid. It supports your Roth IRA's pure growth mission and your 401k's stability, sleeves drip reinvestment strategy, without interfering. The fourth account you should open is a health savings account, and this one is a quiet powerhouse. If you're not a heavy user of healthcare and you're eligible for a high-deductible health plan, an HSA becomes one of the most underrated, overpowered financial tools in the entire system. Most people barely scratch the surface of what it can do. You're not going to be one of those people. Let's break down why an HSA is such a big win. 1. The triple tax advantage, the strongest tax benefit in the U.S. system. An HSA gives you 3 layers of tax efficiency: tax-deductible contributions, tax-free growth, tax-free withdrawals for qualified medical expenses. Nothing else offers this combination. Not your 401k, not your Roth IRA, only the HSA. This is why financially disciplined people treat it like a secret weapon. 2. Your contributions roll over forever. Unlike an FSA, there's no use it or lose it. Your HSA balance rolls forward every single year, can be invested, can compound for decades. It quietly becomes a medical retirement account sitting in the background, growing while you live your life. 3. You can invest the money. Once you pass your provider's minimum cash requirement, the rest can go into index funds, ETFs, mutual funds. At that point, your HSA transforms into a stealth IRA, except with better tax treatment. Tax-free growth plus tax-free withdrawals equals unmatched efficiency. 4. After age 65, it becomes even more flexible. At 65, you can withdraw money for any purpose. You simply pay ordinary income tax just like a traditional IRA. But here's the kicker. Medical withdrawals stay tax-free forever. And since healthcare is one of the biggest retirement expenses, this is a massive advantage. 5. It pairs perfectly with a high-deductible health plan. If you're already on an HDHP, an HSA helps you. Offset higher deductibles. Build a medical safety net, reduce taxable income. It's a smart pairing. The plan gives you access, and the HSA gives you leverage. 6. You can reimburse yourself years, even decades, later. If you save your receipts, you can. Pay medical expenses out of pocket today. Let your HSA grow untouched. Reimburse yourself tax-free in the future. This turns your HSA into a long-term compounding engine with built-in flexibility. Bottom line, a health savings account isn't just a place to store medical dollars. It's a triple tax-advantaged, long-term compounding machine that supports your entire financial system. It gives you tax efficiency, investment growth, flexibility, long-term optionality. And it does all of that without interfering with the pure growth mission of your Roth IRA or the stability mission of your 401k. Why does the second act investor portfolio system work? Because the market is emotional. People are emotional. But rules? Rules don't panic. Rules don't chase hype. Rules don't care about headlines. They just execute. Quietly, consistently, relentlessly, and over time, consistency beats chaos every single time. You don't need to be perfect. You just need a system you trust, and the discipline to follow it. And the easiest way to stay disciplined? Automate everything. No willpower. No second guessing. No emotional detours. Once your system is automated, you unlock the full power of the second act investor portfolio engine. You put yourself in position to rebuild, regain control, and move confidently toward financial freedom. All you need are 5 accounts, each with a clear purpose. The first account is an employer 401k, your stability engine and your US, an international core. The second account is a Roth IRA, your pure growth engine. The third account is a retail brokerage account, your tax-efficient dividend and growth overflow engine. The fourth account is a health savings account, your triple tax advantage engine, and the fifth account is a high-yield savings account, your emergency fund and liquidity base. Build the system once. Automate it. Let it work for you. Every paycheck, every month, every year. I'm showing you a copy of one of my brokerage and bank account totals. This account is with Merrill Lynch. You're not chasing perfection. You're building momentum, and momentum is what gets you to financial freedom. If you found this helpful, go ahead and subscribe and hit the thumbs up. It makes a real difference. It helps the algorithm share this information with more people who are trying to rebuild and take control of their financial future. And as always, thank you for your support. It means more than you know.